Interest rates are everywhere in the news right now. The Fed cut rates to 3.5 to 3.75% in December 2025, but there's debate about whether they'll cut twice more in 2026 or hold steady. Beginners see this and immediately think, should I change my entire strategy? Here's the truth. Interest rates do matter, but not in the way most people think, and beginners massively overthink which part actually affects them.
Here's what's actually happening in December 2025. The Fed voted 9-3 to cut rates by 0.25%, which is unusual. 3 dissents hasn't happened since 2019. Governor Miron wanted a bigger 0.5% cut, while Goolsbee and Schmid wanted no cut at all. The committee is divided because inflation remains somewhat elevated, while unemployment sits at a low 4.2%. Translation: the economy is in a weird spot where it's neither overheating nor crashing, so nobody agrees on the perfect move.
When beginners hear interest rates changed, they think they need to do something immediately. Sell bonds, buy different stocks, completely restructure. But here's what actually happens. According to U.S. Bank's December 2025 analysis, despite high interest rates, solid corporate earnings growth supports equity prices. The S&P 500 is up 16% for 2025, even with elevated rates. Most beginners overthink the tactics and underthink the fundamentals. Let me show you what actually matters.
Here's the part that does matter. When interest rates rise, existing bond prices fall. When rates fall, bond prices rise. It's an inverse relationship that's almost mathematical. Charles Schwab's 2025 analysis confirms when rates go up, bond prices go down. When rates go down, bond prices go up. If you own bonds or bond funds, rate changes affect your holdings. But here's the key. This only matters if you're selling before maturity. If you hold to maturity, you get your principal back regardless of price fluctuations.
Why do bond prices fall when rates rise? Simple. Imagine you own a bond paying 2% interest. The Fed raises rates, and now new bonds pay 4%. Nobody wants your 2% bond when they can get 4%. So your bond's price drops to make up the difference. According to Fidelity's 2026 bond outlook, the current aggregate yield suggests forward 5-year returns of 4.7%, much better than the near-zero yields we had a few years ago. Higher rates actually benefit new bond investors through better income.
What about stocks? The relationship is less direct. U.S. Bank notes that rates can move for multiple reasons at once, and stocks may react differently depending on what drives the move. If yields fall because inflation cools while growth holds up, stocks respond well. If yields rise because of inflation fears, stocks may struggle. Goldman Sachs' 2025 research found that for large companies, a 100 basis point rate increase has roughly neutral impact on earnings. It's not as simple as rates up, stocks down.
Here's what beginners overthink: trying to predict the next Fed move and adjust portfolios accordingly. The Fed itself can barely predict. Their own projections show huge uncertainty. Participants' rate forecasts can vary by over 1% for the same time period. J.P. Morgan's May 2025 analysis said Powell's message was, "It's too early to tell on future cuts." If the Fed chair doesn't know, you definitely don't. Stop trying to outsmart rate changes and focus on what you can control.
The simple truth for beginners: your asset allocation matters way more than timing rate changes. A 70% stock, 30% bond portfolio will smooth volatility regardless of rate environment. According to U.S. Bank, bonds play a role in providing stable cash flow and offsetting stock volatility. When rates rise and stocks wobble, bonds provide ballast. When rates fall and bond prices rise, you benefit there instead. Diversification solves the rate timing problem automatically.
Here's the part nobody talks about. Current rates are actually good for long-term investors. J.P. Morgan's February 2025 analysis notes that aggregate bond yields are around 4.7%, with 88% correlation to strong future returns. Compare that to 2020, when 10-year treasuries paid 0.5%. Vanguard's outlook confirms higher yields make bonds a strategic choice. If you're investing new money right now, these rate levels are giving you better income than we've had in 15 years.
The real danger isn't interest rates, it's overreacting to them. Yahoo Finance's December 2025 analysis shows divisions at the Fed that defined 2025 are expected to carry into 2026. There will always be uncertainty. If you restructure your portfolio every time rates might change, you'll trade yourself into oblivion with taxes and fees. Vanguard's advice? Resist the urge to make significant changes to your portfolio. The calm investor beats the reactive investor every time.
So, what should you do? Step 1. Check your asset allocation annually, not monthly. Ask yourself, am I still comfortable with my stock-bond split? If you're 30, maybe 80% stocks, 20% bonds. If you're 60, maybe 60-40 or 50-50. The right allocation depends on your timeline and risk tolerance, not on what the Fed did last week. Rebalance back to your target once per year. That's it. No daily adjustments based on rate speculation.
Step 2. If you own bonds, consider a bond ladder. This means buying bonds with different maturity dates, some maturing in 2, 5, and 10 years. When rates rise, your short-term bonds mature, and you can reinvest at higher rates. When rates fall, your long-term bonds locked in higher rates. SJB Global's 2024 analysis recommends this. As each bond matures, you can reinvest at the current interest rate. It removes the need to predict rate direction.
Step 3. Focus on economic fundamentals, not Fed tea leaf reading. U.S. Bank's December 2025 report emphasizes solid corporate earnings growth supports equity prices despite rate levels. GDP is growing moderately, unemployment is low at 4.2%, companies are profitable. Those fundamentals matter more than whether the Fed cuts twice or 3 times next year. As long as the economy isn't in recession, your diversified portfolio should perform fine, regardless of rates.
Step 4. Limit how often you check rate news. CNBC's November 2025 advice is golden. Stay focused when interest rates shift, and don't let daily headlines drive decisions. Check your portfolio quarterly, not daily. Read Fed announcements if you want, but don't trade on them. Remember, even Fed members disagree on what to do, as shown by the 9-3 vote split. If they're uncertain with all their data and economists, you checking CNBC hourly isn't adding clarity.
Let's zoom out for perspective. Interest rates hit 20% in 1981 under Paul Volcker. They fell to near zero in 2020. Now they're at 3.5% to 3.75%. Through all of that volatility, diversified investors who stayed invested build wealth. The Advisor Perspectives analysis of December 2025 shows rates have undergone significant fluctuations for decades, yet patient investors succeeded. The rates themselves matter less than staying invested through the cycles.
Who should actually pay close attention to rates? 3 groups. 1. Retirees living off bond income. Your yields directly affect your lifestyle. 2. People buying houses soon. Mortgage rates matter a lot. 3. People refinancing debt. Lower rates save real money. But if you're a 30-year-old investing for retirement, rate changes are background noise. Your 30-year timeline smooths out all rate cycles. Goldman Sachs notes the levels of bond yields are not as important as the factors affecting them for long-term equity investors.
The smart beginner move? Build a diversified portfolio matched to your timeline, not the Fed's timeline. Vanguard's guidance is perfect. A well-diversified portfolio is your best ally, and you should stay focused on your long-term plan. Whether rates are 2%, 4%, or 6%, A balanced portfolio of index funds adjusted annually will serve you well. Stop trying to outsmart rate cycles. Instead, build a portfolio that works in any rate environment.
Bottom line, interest rates still matter. They affect bond prices, borrowing costs, and income yields. But beginners overthink the prediction game and underthink the allocation game. You don't need to forecast Fed moves. You need a properly diversified portfolio that works whether rates go up, down, or sideways. The calm, diversified investor beats the reactive rate timer every time. If this helped, hit that like button, subscribe for more calm, smart investing advice, and comment, are you overthinking rates or staying focused? Let's build wealth the smart way, without the hype.